Preparing for a fund financial reporting, preparing fund financial statements, US GAAP, IFRS, Lux GAAP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the key components of a fund financial statement package. The interviewer wants to assess whether you understand the full reporting output for an investment fund, including primary statements, schedules, notes, and how everything ties back to NAV. While answering, focus on the statement set, schedule of investments, notes, NAV tie-out, capital activity, valuation disclosures, and reconciliation to the trial balance and investor reporting. A complete fund reporting package starts with the primary statements, statement of assets and liabilities, operations, changes in net assets or partners' capital, cash flows where required, and the schedule of investments. I then support them with notes covering valuation, financial instruments, fees, related parties, commitments, contingencies, and risks. The key is consistency. The NAV, capital activity, investment roll forward, and investor allocations must all reconcile back to the trial balance. Question 2. Before preparing audited fund financial statements, what reconciliations would you perform? This question evaluates your practical close process knowledge, especially whether you can identify the core reconciliations needed to produce complete, accurate, audit-ready fund financial statements. Make sure to cover trial balance review, cash and custodian reconciliations, investment holdings, capital activity, income and expense accruals, valuation support, and tie-outs to prior year financials. I start with the trial balance, then prove the NAV. Investments reconcile to administrator records, custodian statements, broker reports, and valuation files. Capital activity must agree to investor notices and bank movements. Income, expenses, management fees, incentive allocations, and FX are reviewed against support. Finally, I tie every financial statement line item to lead schedules and confirm opening balances agree to prior audited financials or approved launch records. Question 3. How are investments generally measured in fund financial statements under US GAAP and IFRS? The interviewer is testing your understanding of fair value accounting for investment funds, including measurement basis, unrealized gains and losses, and differences from historical cost accounting. In your answer, talk about fair value, exit price concepts, observable versus unobservable inputs, unrealized gain recognition, IFRS 13, ASC 820, and Lux GAAP policy considerations. For most investment funds, investments are carried at fair value, not historical cost, because NAV should reflect current economic value. Under US GAAP and IFRS, fair value is usually an exit price, using observable inputs where available, and valuation techniques for private assets. Unrealized gains and losses flow through operations or profit and loss. Under Lux GAAP, fair value presentation depends on the fund regime and accounting policy, so I check the offering documents and applicable law. Question 4. What are the main presentation differences between US GAAP, IFRS, and Lux GAAP fund accounts? The interviewer wants to assess your ability to compare reporting frameworks and understand how terminology, statement format, disclosure depth, and legal requirements affect fund financial statements. Be sure to mention statement naming, financial highlights, IFRS comprehensive income, fair value disclosures, Luxembourg legal formatting, CSSF practice, prospectus requirements, and the need for mapping templates. The first difference is terminology and prescribed presentation. US GAAP investment company statements emphasize assets and liabilities, operations, changes in net assets, cash flows, and financial highlights. IFRS uses statement of financial position, comprehensive income, changes in net assets, and cash flows with IFRS 13 fair value disclosures. Lux GAAP can be more legal form driven, often shaped by fund law, CSSF expectations, and the prospectus. I always map captions before drafting. Question 5. What is the purpose of the schedule of investments, and what would you check before issuing it? This question evaluates whether you understand one of the most important fund reporting schedules, including its role in supporting valuation, classification, concentration, and disclosure requirements. While answering, focus on holdings detail, cost, fair value, percentage of NAV, asset classification, fair value hierarchy, restrictions, portfolio tie-outs, and consistency with risk disclosures. The schedule of investments is the bridge between portfolio records and financial statements. It shows what the fund owns, usually by asset type, geography, industry, maturity, or fair value hierarchy. I verify cost, fair value, percentage of net assets, currency, and any restrictions or Level 3 designations. For private funds, the schedule also supports concentration risk and valuation disclosures, so small classification errors can create audit comments. Question 6. How would you calculate and present partners' capital or investor capital in the financial statements? The interviewer is testing your understanding of investor-level accounting, capital activity, allocations, and how the statement of changes in net assets connects to investor reporting. Make sure to cover opening capital, subscriptions, redemptions, transfers, equalization, income allocation, expense allocation, carried interest or performance fees, ending capital, and agreement-driven methodology. I would build from the partnership agreement or prospectus, not from a generic template. First, post subscriptions, redemptions, transfers, and equalizations. Then allocate profit and loss using the agreed methodology, such as pro rata capital, series accounting, or share class NAV. After that, calculate management fees, performance fees, carried interest, or incentive allocations. The ending capital by investor must tie to total net assets and to investor statements. Question 7. How do management fees and performance fees affect fund financial statements? The interviewer wants to assess your knowledge of fund expense accruals, incentive economics, legal document interpretation, NAV impact, and downstream allocation consequences. In your answer, talk about fee bases, accrual timing, committed capital versus NAV, hurdles, high watermarks, crystallization, investor-specific charges, and impact on expenses and capital allocations. Fees are accruals driven by legal documents. I read the fee base, rate, timing, crystallization terms, hurdle, high watermark, catch-up, and whether fees are charged to the fund or specific investors. For a 2% management fee on committed capital, I accrue it over the period even if cash is paid later. Performance fees require extra care because an incorrect NAV before fee calculation cascades into investor allocations and disclosures. Question 8. How would you prepare the statement of cash flows for an investment fund? This question evaluates your understanding of cash flow classification for funds, including investment purchases and sales, capital transactions, framework differences, and reconciliation to actual liquidity. Be sure to mention direct versus indirect method, operating classification for investments under US GAAP, IFRS policy choices, capital activity, non-cash items, and bank reconciliation tie-outs. Cash flow presentation depends on the accounting framework and fund type. Under US GAAP, many investment companies present operating cash flows using the direct method and treat purchases and sales of investments as operating activities. IFRS classification can vary, but consistency and policy disclosure matter. I reconcile cash flows to bank statements, realized investment activity, capital transactions, and non-cash movements, so the statement explains liquidity, not just accounting profit. Question 9. What disclosures are required for Level 3 investments, and how would you prepare them? The interviewer is testing your fair value disclosure knowledge, especially for illiquid assets where valuation techniques, unobservable inputs, roll forwards, and sensitivity analysis are key audit focus areas. While answering, focus on fair value hierarchy, Level 3 roll forward, purchases, sales, transfers, realized and unrealized gains, valuation techniques, unobservable inputs, sensitivity, and statement tie-outs. Level 3 disclosure is about transparency over hard-to-observe valuations. I prepare a roll forward from opening fair value to purchases, sales, transfers, realized gains, unrealized gains, and closing fair value. Then I disclose valuation techniques, key unobservable inputs, sensitivity where required, and changes in methodology. I also check that realized and unrealized movements tie to the income statement, and that transfers between levels follow the fund's stated policy. Question 10. When would an investment fund consolidate an entity versus measure it at fair value? This question evaluates your understanding of investment company and investment entity accounting, including the exception from consolidation, and the need to assess subsidiaries or structured vehicles carefully. Make sure to cover US GAAP investment company guidance, IFRS investment entity guidance, fair value through profit or loss, portfolio investments, service entities, blockers, and purpose-based assessment. Investment funds usually do not consolidate portfolio investments if they qualify as investment companies under US GAAP or investment entities under IFRS. Instead, controlled investments are measured at fair value through profit or loss. The logic is that investors evaluate performance on fair value, not consolidated operating results. I would still assess subsidiaries used for investment services, financing vehicles, or blockers, because some may need consolidation, depending on purpose, ownership, and the applicable framework. Question 11. How do you recognize investment income and fund expenses at period end? The interviewer wants to assess your grasp of accrual accounting, cutoff, income recognition, expense completeness, and how these items affect NAV accuracy. In your answer, talk about interest, dividends, realized income, expense accruals, invoices, service periods, tax accruals, cutoff procedures, and consistency with accounting policies. I use accrual accounting. Recognize income when earned and expenses when incurred, not when cash moves. Interest income may use effective yield or contractual accrual, depending on asset type and framework. Dividends are generally recognized on X date. Expenses are accrued based on service periods, invoices, and fee agreements. I then review cutoff around year-end, because missing audit fees, administration fees, withholding tax, or interest accruals can materially distort NAV. Question 12. How do foreign currency transactions affect fund financial reporting? This question evaluates whether you understand functional currency, translation, realized and unrealized FX gains, share class impacts, and presentation within fund financial statements. Be sure to mention functional currency, transaction currency, closing rates, average rates, monetary items, realized FX, unrealized FX, hedged share classes, and financial statement presentation. FX matters because funds often have a functional currency but hold investments, cash, and investor capital in other currencies. I translate monetary balances at closing rates and income or expenses at transaction or average rates, depending on policy. Realized and unrealized FX gains must be separated or clearly presented. I also check share class hedging and investor-level FX impacts, because a correct fund NAV can still produce wrong class-level statements. Question 13. What notes and risk disclosures would you expect in a fund's annual financial statements? The interviewer is testing your knowledge of qualitative and quantitative disclosures, especially whether you can move beyond boilerplate and connect notes to the fund's actual portfolio risks. While answering, Focus on accounting policies, valuation, financial instruments, fair value hierarchy, market risk, credit risk, liquidity risk, currency risk, related parties, fees, tax, commitments, and contingencies. Notes should help users understand what drives NAV and risk. I expect disclosures on accounting policies, valuation methods, fair value hierarchy, financial risk, related parties, fees, taxation, commitments, contingencies, and subsequent events. For funds, concentration, liquidity, credit, market, currency, and interest rate risks are critical. I make disclosures specific to the portfolio, not boilerplate, and reconcile note tables to the financial statements and underlying lead schedules. Question 14. What would you pay special attention to when preparing Lux GAAP fund financial statements? The interviewer wants to assess your practical awareness of Luxembourg fund reporting, including legal form, fund regime, CSSF expectations, accounting policy choices, and prospectus alignment. Make sure to cover fund type, legal structure, valuation basis, annual report format, CSSF practice, share classes, subscription tax, NAV presentation, constitutional documents, and prospectus consistency. Under Lux GAAP, I first identify the fund type, legal form, and whether the accounts follow fair value or another basis allowed by the constitutional documents and Luxembourg rules. The annual report format is often driven by fund law and CSSF practice. Compared with IFRS, disclosure may be less principles-heavy, but more document-specific. I pay close attention to share classes, NAV presentation, tax subscription charges, and alignment with the prospectus. Question 15. If auditors challenge a financial statement line item, how would you handle it? This question evaluates your audit support skills, documentation discipline, technical judgment, communication style, and ability to resolve issues without compromising reporting quality or controls. In your answer, talk about identifying the issue, tracing to support, reviewing accounting policy, quantifying impact, proposing adjustments, referencing standards, communicating clearly, and maintaining an audit trail. When auditors raise a comment, I first determine whether it is support, presentation, disclosure, or technical accounting. Then I trace the item to the source document, lead schedule, trial balance, and accounting policy. If the auditor is right, I quantify the impact and propose an adjustment. If not, I provide a clear rationale with references to GAAP, IFRS, Lux requirements, or fund documents. The goal is fast resolution, weakening control discipline. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video.